welcome on our channel. Today we are going to discuss one of the international bestseller book, One Up on Wall Street by Peter Lynch. This book has been sold more than 1 million copies over the world, in which this book, Peter Lynch explained the advantage of the average investor like we do compared with the professional investor. And also the most important thing from this book is actually how we can get the advantage from the investment point of view to enrich our stock performance. Peter Lynch, born 19 January 1944, is an American investor, mutual fund manager and philanthropist. As the manager of the Magellan Fund at Fidelity Investment between 1977 and 1990, Lynch averaged a 29.2% annual return, consistently more than doubling the S&P 500 market index and making it the best performing mutual fund in the world. During his tenure, assets under management increased from $18 million to $14 billion. Popular myth ever said that people may be born with a knack in stock investment. However, in fact, there is no one born with such a gift. Skill for stock investing is not something that is given in our genes, but people have to do proper research to become skillful on stock investment. Many people, including Lynch family, have never distrusted the stock market. However, during Lynch's experience as a caddy in a golf course, when he listened to many conversations with his client discussing the stock market, he realized that the positive evidences beat the negatives. After saving some money, he decided to buy stock for the first time at $7 per share, and he had luckily invested in an air freight company when America decided to go to war. The stock rates hiked up and he knew that bigger things were going to come. The average investor who invests in stock often confronts an oxymoron. Professional investors are also oxymoron, even though not all of them like that, but free thinkers like Max Hein have also done a fantastic job at making money. Not necessarily have to become professional or have to pass business school to start stock investing. They read the same magazines or books we do, but it is important to understand what you are searching for. There are many reasons where people who have not even attended business schools have done spectacularly well in the stock market. That is only because they rely on logic and are never limited by rules that are set by stock investment professionals.
I wish I found some better sounds no one's ever heard.
The bottom line highlighted in this chapter is be wise and smart investor. Before jumping the gun in buying any stock, any individual or potentially willing to be an investor should ask these three crucial questions. Question number 1, do I own a house? It is highly critical that any individual should put this as a top priority. Buying a house is one of the best investments one can make. It is always secure, safe, smart, and thoughtful choice to prioritize having a place for someone to put roof over his or her head and a place to come home to in the first place. Other consideration to put in mind is that a house can be owned by same person while stock can be owned by many different persons each year. It takes very careful steps and time before making a choice of which house to buy, while it takes less than 5 minutes for one to pick and choose which stock to buy. In a nutshell, own a house first and go ahead pursuing your wish to buy a stock. Question number 2, do I need money? If your answer to this question is yes, then sorry, you can't use that money to buy stock no matter how appealing the stock can be. If you need the money for your kids' education, health bill, day-to-day needs, this simply means that if you can't afford to have a risk of losing the money at all, you can go ahead investing your money in stock given its risks, predictability, and volatility only if you are okay and it doesn't hurt you that much to have possibility of losing the money and it doesn't disrupt your life and future plans. You shall never be impulsive. The question number 3 is, do I have the personal qualities that will bring me success in stock investing? You cannot be panic or impulsive when you buy stock. As an investor, you need to have the ability to make decisions without complete information. Make sure you are not in rush when there is fluctuation in the market. You shall not rely on your gut feelings only, but rather to discipline yourself to ignore them. Stand firm on your stock as long as the fundamental story of the company hasn't changed, because averagely 50% of stock price is fluctuating in a year. Hence, the phenomenon shouldn't cause a shock. One may be torn apart between choices when it comes to investing his or her money to choose whether to invest in bond or in stock. Should one gamble in reaching this decision? In order to make an informed decision, an investor should understand the difference between bond and stock and the different risks both are exposed to. Bond is more certain investment when it comes to risk exposure, although it will give relatively small return in percentage to the investor, but it is very much less risky. Conservative will definitely like it. In opposite, stock lures investor with high returns but with greater risk. It can be high in returns but at the same time can be extremely low to the point that the investor may lose the money which has been invested. The best advice is to diverse the investment instruments with one portion for stocks and the other portion in bonds. This is true. However, if those professional economists can't even predict economies and those professional forecasters can't predict markets, then what makes one think that an amateur investor can do such? You can't really predict the market and economy and be caught up about it. One time in the past, you found out that the stock price is going down and you foresee it may happen again, and by that time, the price is inflated. One time recession strikes and you worry and take very careful steps, and by the other time, it's going well. Several principles that investors should keep in mind in order to help them to sleep well at night are: first, predicting the economy is futile. Second, invest in a house before you invest in a stock. The third one, invest in companies, not in the stock market. And the last one, ignore short-term fluctuations. Just don't worry too much.
Havana, ooh, nah, nah. Half of my heart is in Havana, ooh, nah, nah. He took me back to East Atlanta, nah, nah, nah. All of my heart is in Havana. There's something about his manners.
Understand the basic business is an easier way to getting the story on company. The perfect stock will be attached to the perfect company, and Lynch favors the most important attribute to get the kind of stock he dreams about. Lynch favors the boring name, the perfect company related in perfectly simple business, which ought to boring name but easy to run. Also likes companies which have some degree of disagreeability to them. Lynch favors the companies who like spin-off companies when the constitutional investors are not involved with companies that have a niche, like gravel, because it's costly to move the products and to deliver them to the sites. Companies that have repeat business will continue to sell more in the future. Main points to be success in stock is keep your eyes open on any company information, to finding investment ideas and do the research on its financial and the price of its stock. Because investing without research, it's like gambling without looking at the cards. There are almost as many ways to classify stocks as there are stockbrokers. But Peter Lynch have found 6 categories which cover all of the useful distinctions. These are slow growers or stalwarts, fast growers, cyclical companies, turnaround asset plays, and companies. There is kind of stock that Lynch avoid, and he gave a criteria of this. Lynch will avoid the hottest stock. Mostly the hot stock using the momentum. It's easy to go up fast and also fall just as quickly. Other stock trying to be the next big company should to avoid. It often marks the end of prosperity. Avoid diversification when companies outside their area of expertise. Beware the whisper stock. Whisper stock has hypnotic effect stories with emotional appeal. It will make lost money in long-term position. Beware the middle name don't buy companies with a very small list of customers because they have monopoly power. Stay away from stocks with exciting names, i.e. calm, dumb names.
So even when there is so much information available at our finger, investors still tend to believe that they have an edge by just believing in a rumor. Information was scarce earlier, but companies now have to display everything, including prospectus, annual report, quarterlies, which are available to everyone. If that is enough, you can even call or visit the company to indulge in a bit more research. In the world of investing, facts are as important as the earnings of the company. In chapter 13, any question? What number should interest you when picking stocks? Well, there are many, but Lynch talked about a few. Firstly, the sale percentage should be attractive. For example, if you're looking at Lexan Plastic, for example, then you should note that it generates only 6.8% of GE revenue, which may not be a great deal for the shareholder. And secondly, study the PE ratio, which should be proportional to growth rate of fairly priced company. And thirdly, analyze the cash position that give a clear understanding of how much cash the company holds. State that whatever the stock is, like cyclical, fast grower, stalwart, slow grower, turnaround, or asset play, you want to buy, you need to be able to come with reason. So the Lynch argue that in order to see massive return of time, long-term investment is must, which is hard to argue with.
I wish I found some better sounds no one's ever heard. I wish I had a better voice that sang some better words. I wish I found some chords in an order that is new. I wish I didn't have to rhyme every time I sang. I was told when I get older all my fears would shrink, but now I'm insecure and I care what people think.
My name's Blurry Face and I care what you think. My name's Blurry Face and I care what you think.
Let's categorize the stock into 6 different categories. First, slow growers. These are large companies and usually older. They pay dividend regularly. However, since the growth is small, you better not to expect huge returns from this company. Second one, stalwarts. These are multi-billion-dollar company, slow moving in terms of new product release, but remain strong through recession period. You can expect this company perform well during bad or good time, and their return is not great, just decent. 3. Fast growers. These are smaller, aggressive, not always small, companies that can grow at least 30% a year. It is not necessary in a fast-growing industry. Just find a company that gaining the market share faster than other companies in that industry. Third, fast growers. These are smaller, aggressive, not always small, companies that can grow at least 30% a year. It is not necessary in a fast-growing industry. Just find a company that gaining the market share faster than other companies in that industry. This type of investment are Lynch favorites. 4. Cyclicals. These are companies where the rise and fall affected by a cyclical change in macroeconomic and sector-specific condition, like new regulation, government election, etc. Investing in such company are the riskiest since it's very volatile. Timing is very important here. If you buy in the wrong time, then you will get lost. There is a debate between investment analysts whether put all your eggs in one basket or don't put all your eggs in one basket, which sometimes confusing beginner investor. We can see from different point of view. It is not only a matter of single stock or maybe a dozen of stock unless you already investigate how good they are on detailed fundamental analysis in case-by-case basis. It is best to have as many stocks where you already uncover an exciting prospect that pass all the test research. Some benefits if you have more than 10 stocks are, the more stock you own, the more likely one of them will become 10 bigger. And the more stock you own, you have flexibility to rotate funds between them. Spreading your money into several stock categories is another mitigation to minimize the downsizing risk. Again, knowledgeable buying is the key. Do some research first before decide. Related with portfolio management, instead of sell the stock when they are going down, it would be better to rotating the stock depend on the fundamental situation. You will save yourself from mistime moves and wrong assumption. So, a price drop is an opportunity to load up on the bargains from among your worst performers and your laggards that show promise. The best time to buy the stock will always the day when you have convinced yourself you have already found solid performance at a good price. However, in this case there are two particular periods. During peculiar annual ritual of end of the year tax selling and during the collapse and free falls that occur in the stock market every year. If you know why you bought a stock in the first place, then you probably have a better idea of when to sell it.
Dangerous things people say about the stock price. First, if it has been gone down this month already, it can't go much lower. You can never know the lowest point of the stock, like you can never know its pinnacle. People who think about this, they are foolish. The second, you can always tell when a stock hit bottom only because stock has fallen the great levels. It doesn't imply it will not fall any further. It may be always. The third, it has been gone this high already. How can it possibly go high? No artificial limit decide how high stock might go. The fourth, it's only $3 a share. Usually people say that only $3 a share. what can I lose? The clear answer is $3 per share. Such mindset is not good. This is a loss regardless of its size. It loss. Prevent them. You don't want to invest as a loser, of course. And the fifth, eventually they always come back. We know that some firms never return. We'd like to summary what we can learn from the Peter Lynch book. First is do the work. Peter Lynch is very well known, of course, for recommending that investors buy at what stock. Must buy what stock that they have already known. In his classic book, One Up on Wall Street, he recommended that you should never invest in any company before you have done the homework. What's homework? Homework on the company's earning prospect, the company financial condition, competitive position, plans for expansion, and so forth. The second, please use your age. Lynch strongly believes that everyone has an age that can allow them to outperform their expert. The key is to utilize your age by investing in companies or industries that you understand well. It means that we have to know the economic and generic and then industry and then knowing the company itself very well. He recommended that individuals identify 3 to 5 companies that they could know very well. You could study them, lecture on them, and understand their stories intimately. Ultimately, Lynch felt that ordinary folk need to discover their personal age, whether it's profession or hobby or even something else like being a parent. And the last is be patient. Being patient and investing for the long term should be the simplest investing lesson of all. In 1960, the average holding period of stock was 8 years. Nowadays, it's just 4 months. Lynch often said that he had no idea what the market would do in 1 or 2 years, but he was confident about what stock would do 10, 12, or 30 years from now. He truly believed that time was on the side of the retail investor, and that's why he was an enthusiastic proponent of long-term investing. And yes, he aware of some long-time frames when the market didn't do well. He referred to the period of from 1966 to 1982, when the market was flat for the most part. But Lynch noted that you have still received dividend from your stock. He also felt that corporate profit tend to trend upward and that investor would eventually be rewarded for it. Thank you very much. First, you should fully understand the nature of the companies you own and the specific reason for holding the stock. It's very clear that we have to understand well what the company we are going to buy its stock. And the second, please consider the size of the company you expect to profit from a specific product.
The next lesson learned from this book is be suspicious of companies with growth rates of 50 to 100% a year. And the other lesson learned that we can take from this book is distrust diversifications, which usually turns out to be diversifications.
The next lesson learned is people get incredibly valuable fundamental information from their jobs and may not reach the professional for months or every years.
Another lesson learned is separate all stock tips from the tipper, even if the tipper is very smart, very rich, and his or her last tip went up.
The seventh lesson learned from this book is invest in simple companies that appear to out of favor and have not been caught in the street. And the eighth lesson learned is company that have no doubt can go bankrupt.
And the last but not least is devote at least an hour a week to investment research. Adding up your dividends and figuring your gains and losses doesn't count. And when in doubt, tune in later.
Thank you very much.
Satu, gaya dong. 2, 3. Yeah, orang lagi video.
Emang lagi cantik.
Just don't worry too much.
Hai sayangku, hari ini aku cantik, cantik bagai bidadari, bidadari di hatimu. Hai sayangku, perlakukanlah diriku seperti seorang ratu, ku ingin dimanja kamu. Sayangku, hari ini aku cantik, cantik bagai bidadari, bidadari di hatimu. Hei sayangku, perlakukanlah diriku seperti seorang ratu, ku ingin dimanja.